The Federal Reserve's conventional approach to inflation management is undergoing a fundamental reevaluation as structural shifts in the American economy exceed consensus expectations from just a year ago. Released today at 2 p.m. Eastern Time, the January FOMC meeting minutes reveal a central bank balancing cooling price indices against an unexpected surge in business productivity. While headline figures indicate that the effort to stabilize prices is yielding results, with inflation reaching its lowest level since May 2025, the Federal Reserve remains hesitant to pivot toward an accommodative stance. A prominent factor in this caution is a measurable rise in business efficiency, driven by sustained investment in artificial intelligence, which is prompting a foundational debate over the neutral rate of interest. The internal deliberations from the January session reveal a rare 10-2 split among voting members, signaling a departure from the committee's recent era of unanimity. While the majority opted to maintain the benchmark federal funds rate at its current range of 3.5% to 3.75%, Governors Christopher Waller and Stephen Miran emerged as formal dissenters. Both officials advocated for an immediate 25 basis point reduction, arguing that with inflation at 2.4%, the Fed risks becoming reactive rather than proactive. Their dissent centers on the concern that maintaining restrictive policy for an extended period could unnecessarily jeopardize labor market stability. Conversely, the majority consensus, led by Chair Jerome Powell, introduced new two-sided guidance, suggesting that while the committee remains open to future cuts, it is equally prepared to resume rate hikes should progress toward the 2% target stall or reverse. This institutional caution found further validation this morning in the U.S. Census Bureau's report on durable goods. While total orders saw a 1.4% decline, largely attributed to volatility in defense and transportation, the core figure advanced by 0.6%. This metric, representing non-defense capital goods excluding aircraft, doubled the consensus forecast of 0.3%. This outperformance provides concrete evidence that American corporations are aggressively allocating capital toward equipment and technology, despite borrowing costs that remain elevated relative to the post-2008 average. Analysts identify this trend as the AI CapEx cycle, characterized by a strategic willingness among firms to absorb higher financing costs to secure the infrastructure necessary for long-term automation and operational efficiency. The resilience of the broader economy has led Fed Governor Michael Barr and a growing faction within the committee to question the current location of the neutral rate of interest, or R-star. This theoretical level represents the interest rate at which the economy neither expands nor contracts. Historically, an inflation rate of 2.4% paired with a policy rate above 3.5% would have been considered significantly restrictive. However, if artificial intelligence is fundamentally increasing the productivity of the U.S. workforce, the economy may be capable of sustaining higher growth without triggering inflationary pressure. In this scenario, a 3.5% interest rate may no longer be acting as a brake on activity, but rather as a neutral setting. Such an intellectual shift recalibrates the expected timeline for American consumers seeking a return to the low interest rate environment of the previous decade.
For the American homeowner, the implications of this higher-for-longer neutral rate are becoming increasingly tangible. National average 30-year fixed mortgage rates currently sit at 6.19%, while refinance rates are holding at 6.47%. Because the Federal Reserve sees no immediate necessity to stimulate an already resilient economy, market observers expect these rates to remain within the 6.0 to 6.5% corridor through the first half of the year. The impact on the housing market is already measurable. January home sales declined by 8.4% as potential participants remain sidelined, awaiting a more definitive downward trend in financing costs that has yet to materialize. The labor market presents a similarly complex picture of stability shadowed by transition. The unemployment rate held steady at 4.3% in January, supported by a gain of 130,000 payrolls. While these figures suggest headline stability, the internal nature of the workforce is shifting. High business investment in technology supports job security in technical and manufacturing fields, yet the same productivity gains influencing interest rate policy may pose a challenge to administrative and middle management roles. The economy is currently witnessing a low-hire environment in corporate headquarters, even as GDP growth remains solid, creating a bifurcated experience across different segments of the labor force.
Today also marks a critical date for the Social Security Administration, which continues its disbursement of payments to beneficiaries born between the 11th and 20th of the month. These checks reflect the first full implementation of the 2.8% cost of living adjustment, or COLA, for 2026. For those on fixed incomes, the current interest rate environment creates a dual reality. High-yield savings accounts and certificates of deposit are currently providing returns at or above 4%, a level of passive income not seen in most of the previous decade. However, this is partially offset by the persistence of service sector inflation. While the price of physical goods has moderated, the costs of healthcare, property insurance, and home maintenance remain elevated. If the Federal Reserve continues to delay rate reductions, these sticky expenses may continue to erode the real purchasing power of the annual COLA adjustment. In the equity markets, the reaction to the minutes reflects a significant repricing of risk. Investors have largely moved away from the anticipation of a March rate cut, with Fed funds futures now suggesting a 65% probability of a pause at the next meeting. This has created a divergence in corporate performance based on capital structure. Large-cap technology firms, possessing significant cash reserves, are benefiting from higher interest income while leading the AI productivity charge. In contrast, small businesses face increased fiscal constraints. Data from the NFIB indicates that small firms are managing borrowing costs that often exceed 9% on variable rate loans, creating a capital gap that favors larger, more liquid market participants. A significant area of developing concern for the Federal Reserve is the physical infrastructure required to sustain this technological expansion. According to the Bloomberg NEF 2026 Factbook, electricity consumption from U.S. data centers rose by 18% in the last year alone. Total demand has quintupled over the past decade, and with 48 gigawatts of capacity currently under construction, the pressure on the national power grid is mounting. Economists are closely monitoring this energy demand as a potential source of second-wave inflation. If the energy requirements of the technology sector drive wholesale electricity prices higher in the second quarter, the Federal Reserve may find itself in a position where it must consider the possibility of further rate hikes rather than the long-anticipated reductions. The institutional trajectory of the Federal Reserve also remains a primary variable for market participants. The nomination of Kevin Warsh to succeed Jerome Powell as chair in May 2026 is expected to influence volatility in the bond market during his late first quarter confirmation hearings. Warsh is historically noted for his preference for a more limited central bank footprint, yet he is also viewed as a proponent of growth-oriented policies. His potential arrival could signal a more aggressive reduction in the Fed's balance sheet, even if he supports a gradual moderation of the benchmark interest rate. Looking ahead, the next FOMC meeting on March 17th and 18th will serve as the next major inflection point for the markets. Beyond the interest rate decision itself, the market will focus on the dot plot of individual member projections to determine if the 10-to-2 split observed in January expands or contracts. The primary trigger for a pivot in policy remains the labor market. Should the unemployment rate breach the 4.5% threshold in upcoming reports, the camp within the Fed favoring early cuts to protect employment will likely gain influence over the majority's current focus on productivity and inflation containment. In summary, the Federal Reserve is currently navigating an economy that is performing with greater resilience than its own models had anticipated. The traditional relationship between cooling inflation and falling interest rates has been complicated by a structural shift in corporate operations and investment. As artificial intelligence continues to influence capital allocation and labor efficiency, the normal cost of money appears to be settling at a higher level than that of the previous decade. The central bank remains in a state of watchful waiting, balancing the clear progress made on inflation against the unforeseen strength of a technology-driven economic expansion.
While headline inflation has moderated according to official administration reports, wholesale power prices saw upward pressure in the final quarter of 2025. This divergence remains a focal point for the Department of Energy and the Federal Reserve as they assess future inflationary risks. We will continue to monitor the upcoming labor reports and energy price data for any signs of a shift in this economic equilibrium. For now, the Federal Reserve's message is one of cautious stability, prioritizing the durable containment of inflationary pressure.